Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Graham Day. How you doing today, Graham?
I'm doing great. How are you, Kirk?
Doing great. Doing great. Well, glad to have you on the show. I'm excited. Been looking forward to having this conversation for a while, and listeners understand why. But Graham, tell us a bit about your background.
Sure, Kirk. So I had the opportunity to get into the ETF industry early on at a firm that at the time was called PowerShares ETFs back in 2008, 2009. And really set the trajectory for my career. Was there for about 6 years, went to another ETF startup for 3 years, and then was contacted by my first boss at PowerShares, an individual named John Southard, who was one of the co-founders of PowerShares. And he said he was looking at starting something new. And it was intriguing and ultimately made the jump over to Innovator at the beginning, so back in 2017, and then was able to work or been able to work with John and his partner Bruce Bond, our CEO, ever since. And it's been pretty exciting. And really, what we're trying to do at Innovator is to take payoffs that have just never been available in the ETF wrapper and make them available to advisors, their clients, and give them some of these payoffs that maybe were in more expensive wrappers in the past, or just you had to be an ultra high net worth individual to access them, or just for advisors that don't use those types of products. When you put in an ETF wrapper, there's a lot of value that it provides them. And so we've been very fortunate to have a tremendous adoption of these defined outcome ETFs, these buffer ETFs, and the firm has now, 8 years later, has grown to north of $22 billion in AUM.
Okay, cool. So let's talk about some of you throw out a bunch of terms there, and the listeners may not understand them all. You were talking about defined outcomes, put them in wrappers, high net worth products, like all that stuff. Like let's bring it down to the brass tacks for the average investor so they'd understand. So let's talk about kind of an example. So I found you guys maybe like 5 years ago or whenever it was. I forget when you guys started, but I found you guys close to when you first came out. And I think you guys came out with a buffer ETF. And I was looking for something a little more defined, which you guys have now. But initially, I think it was the buffer ETF. So what was kind of the genesis of what your company was looking to do and what problem they were trying to solve?
So, Kirk, when we took a step back and you look at there's a tremendous demand for risk management. And so we know that because when you look at the sales of insurance products or structured notes, or really what those wrappers are trying to achieve is to give investors exposure to the equity markets, but with known levels of downside protection. And that industry is a massive industry, one that we really didn't appreciate the size of, having spent our careers in the ETF industry. But when you take a step back and you see that there are trillions of dollars that are invested in these types of products, that again, many investors, they're not looking to get the full upside or downside of the equity markets. They want to participate, but they also want to protect on the downside. And so that concept had never been available in the ETF wrapper prior to Innovator. And so what we've done at Innovator is to pioneer the ability to invest in equity markets with known levels of downside protection. And again, for whatever reason, those payoffs, those strategies were limited to the high net worth, the affluent investors, or they were in very expensive insurance products as well. And when you place those payoffs in the ETF wrapper, you deliver lower cost, more tax efficiency, ease of access. It really eliminates a lot of the problems that advisors and investors have had with legacy investment in vehicles in the past. It really delivers the benefit of these payoffs, equity upside with no levels of protection directly to the end investor.
Yeah, it's interesting because I hear this a lot when, we do a lot with options strategies with our portfolios. And I talk to a lot of advisors who sell insurance and they're like, oh, we can do this. I'm like, yeah, I can do that too, but I have liquidity. Like, not locking your money up for 10 years or whatever the surrender period is for that annuity product. I'm like, we can do the same thing and provide liquidity. Like why would you go with an insurance product? And I get why. I mean, a lot of commissions built in there and people feel good about it, and you're only priced once a year, like all the things that make it easy for them to sell that product. But um but I was fascinated when you guys did this, because when you came out with a buffer strategy, I remember back in, what was it, 2002, 2001, that I was at Paine-Webber and they had come out with a structured product. And I guess Smith Barney, I think, initially initiated the first ones. I think they were the ones to invent the structured products. And it was, and basically the initial ones were covered calls. Like that's all they were. They were just covered calls. It was like, oh, you could buy JDS Uniphase with a 30%, you're guaranteed 30%, or if it goes below this point, then you own the stock at this price. And I was like, how do you say no to that? It's like my first year in the business, like, that's crazy. Of course I'll do that. And of course, when I was there, the next year and a half, not a single structured product made money for the investors. Not a single one. Every single one of them lost money. It wasn't the positive outcome that was proposed. It was always the downside, because the markets basically went down for the next 3 years. So not necessarily the fault of the structured products, but I found that there was this continued habit of the structured products underperforming what you would expect they would have done on the upside. It was always kind of like the negative, and I was like, these things are garbage, and you can't sell them; they're stuck. So I love when you guys came out with your own versions that are liquid. But doesn't that create an perverse incentive to sell something that you probably should be holding, because that's the whole point?
I mean, you would think so, Kirk, and that was something we weren't sure of when we brought these products to market. But what we found has been the vast majority of the users, the advisors that implement our products, they tend to be more strategic in nature. So they're not buying and selling. They're not trying to find arbitrage opportunities. They're simply using these as core holdings, whether that's to replace a portion of their equities, whether that's used to replace a portion of their bonds, which has been a very common use case of these buffer ETFs over the last few years, or for those clients that they have that are nervous, that would otherwise say, let's just err towards more cash. If you present the opportunity to say, hey, look, we're not going to get all the upside of the equity markets, but what if we get 14% on the upside and we have a known protection of 15% on the downside? For a lot of nervous investors, that gives them the confidence to put a little more money to work in the markets.
Yeah, no, I think it makes a lot of sense. I mean, I've looked through, and I'd love to talk about different maybe not the specific funds, ETFs, but definitely the strategies, because some of them are really fascinating to me. So the original one you guys started out was the buffers. So what's the concept around the buffer ETFs?
So the buffer ETFs, like you said, those were the first defined outcome ETFs that we brought to market back in 2018. And what those products did was to give you exposure to the S&P 500. And we brought three different flavors. One that had downside protection of 9% over a 1 year time frame on the S&P, another that protected against 15% of losses, and the third protected against 30% of losses. And in exchange for that known level of protection, you have to give something up, and that's unlimited upside. And so you're sacrificing unlimited upside for that known downside protection. And as your listeners would probably guess, higher levels of protection are more expensive. So you're going to have less upside potential. But we started with those three ETFs, again, all in the S&P 500. Gave you known levels of upside to the S&P 1-to-1 to a certain cap with that downside protection. And then we're often asked, well, what happens? Are the 1 year products, do they go away? No, they simply rebalance at the end of what we call the outcome period, the 1 year outcome period. And it's important to distinguish that concept versus what you see in other wrappers, because in insurance or structured notes, those products, they come due and it's a taxable event for clients. These ETFs will roll into a new 1 year outcome period on a tax deferred basis. And so there's one thing we can control that is so valuable for clients is the taxes. And so these are perpetual. And as you mentioned, these were the first three ETFs that we brought on the buffers, and then we've since expanded across asset classes, different buffer levels, and in different time periods.
Okay, so it's not there's no K1s or anything. It's just, as long as you hold on to them, there's no taxes.
That's right. There's no K1s, 1099 reporting. These report right alongside all the other stock and bond ETFs. It just simplifies things, and there's no credit risk, right? So you're not taking on the credit risk of an insurance company or a bank. You own through the ETF the individual options that are used to construct these payoffs.
Okay, so if I look at different outcomes, you've got buffer ETFs where it's a buffer downside. There's like a cap, like there's 30% protection, let's say, to the downside. So if it goes down 29%, you're protected. If it goes 31%, you start to lose money. There's those, and then there's some that have zero downside minus the expenses. So why, if you don't have any downside, like there's 100% buffer, like why would you go for something with only 30% buffer? Like how does that work in the construct of an ETF?
Yeah, I think it really comes down to the idea that more protection will mean less upside potential to the equity markets. And so if you have 100% buffer, if you're protecting all of the capital, your upside is going to be lower than if you're protecting, say, the first 15% of upside. And what we found is it just has a different place in advisors' portfolios. A 15% buffer, that might fall somewhere in between a stock and a bond in terms of the risk profile. 100% buffer ETF, we found many advisors using to get client cash off the sidelines, improve tax efficiency. Cash is tax inefficient. You're getting taxed at ordinary income. The 100% buffers will give you more upside potential, but again, on a tax deferred basis. So it really comes down to how much protection are your clients looking for? Where does it fit in the portfolio? And that's why we've brought so many different flavors of these products, is to allow advisors to tailor the exposure to their clients from an asset allocation perspective and from an individual client perspective as well.
So I've noticed it seems to me like you guys are mirroring the structured products suite, anywhere from pretty much income, which are kind of the covered call mirror. You've got the 100% buffer. You've got I haven't seen any barriers, which I hate with structured products. I think those are so dumb, but I get it. And so you have the partial buffers, and you've got, accelerated, which are usually some sort of leveraged version. So are you guys trying to mirror structured products in the suite that they provide, or are you trying to focus on solving specific problem outcomes? Because you guys come out with new products. So like how does the idea generation come when you guys are looking at this?
We always like to use structured products as a guidepost in terms of what advisors are using, what they prefer. One of the things that you'll find with our products, though, is we err towards simplicity. There are a lot of structured products that are often confusing, convoluted. There's four different underlines, and you're going to get the worst of the performance of those four subject to these others. There's a lot of if this, then that, logic. And so what we try to do is just stick to really simple things that advisors can communicate to their clients. And so I think the buffers are just a great example of you can have S&P 500 exposure up to say a 13% cap on the upside, and you'll be protected against the first 15% of losses. And that's it. And you don't have to overcomplicate. And what we found in the ETF industry is complexity rarely sells. It tends to be, you've got 99% and then you're trying to add all this complexity on top, and all it does is confuse the advisors or clients, and it leads to unexpected outcomes. And as you know, Kirk, unexpected outcomes, whether positive or negative, especially negative, are unwelcome surprises for advisors, because their clients are going to come to them and say, "Well, I thought it was this." When you get more convoluted products, it tends to lead towards suboptimal client experience. So we're always going to err towards bringing the most straightforward ideas to market. But we do look at the structured note landscape, because advisors have used those products for decades, but some haven't. And some haven't used the insurance products because they don't like the credit risk. They don't like the lack of liquidity. They don't like the cost, the hidden costs. And so some of them have never even looked at these payoffs before. But once you put in the ETF wrapper, as I mentioned earlier, you kind of cut away all this complexity and uncertainty on fees and liquidity, and it just becomes more straightforward for advisors and their clients to implement.
Yeah, no, I agree. So you have defined outcomes and you have managed outcomes. What's the difference in your mind between the two?
So defined outcome, we like to describe as those are very precise instruments. And let's say you have a client that is set to retire in 2 years, and they're a little more risk averse, and so you want to provide a very defined investment for them over the next 2 years. That's where we'll see advisors using our defined outcome. They want to be able to communicate, "Hey, look, over the next year, here's exactly what you're going to get." But then we also have advisors who say, "Well, I'm less concerned about getting a defined outcome, but I love this concept of having built-in risk management to the product." And so rather than using a defined outcome, what we've done is we've taken the same building blocks of defined outcome ETFs, and that's the use of options to deliver the risk management. And then instead of having a precise time frame, we ladder the time frames. And so it's not a defined outcome, but it's a compilation of defined outcomes in a single ETF. And so advisors have a good idea of what they're going to get. They don't need to know, okay, 6 months from now, what exactly am I going to get? They're using the managed outcome ETFs more as a single ticker solution, maybe for their model portfolios. And it's for many advisors just easier to implement the managed outcome ETFs than the defined outcome ETFs.
Yeah, no, that makes a lot of sense. So one thing that I found is challenging in portfolio management. So the whole industry is basically built on asset allocation. All the tools, all the technology, everything's based on, MPT, efficient frontier, all that crap. Like and frankly, all that stuff used to work, but it doesn't work as much anymore because we don't have, we have high correlations with pretty much most assets now, so it doesn't really function the way it should. Now, I had a conversation with a guy a while ago who was focused mostly on tactical investing. And tactical is kind of like one of those weird things that people just like, snub their nose at because they're like, oh, tactical, like whatever. And it's only because they can't define it. It doesn't fit in a nice little box for people. And so people are like, tactical doesn't work. And it's like, well, you just because you don't understand. Some work, some don't, right?
That's
But
right.
I've always thought, well, if you're diversifying assets, that doesn't work very well because everything's correlated now. But if you diversify strategies, that can work. And I remember seeing a TD Ameritrade conference years ago. There was a guy talking about, I think it was an option strategy, like the broken butterfly, which nobody's going to understand. But anyway, the point was is he was measuring. He said this actually is non-correlated, and here's why. And he went through. I'm like, that's really interesting. I don't want to do that, but it's an interesting perspective of maybe different strategies are a better way to allocate portfolios. So I'm going through this and I'm looking and I realize because I've looked at your guys' stuff before and I like many of the things you guys do, but I realized in order to put together a diversified portfolio, it's really, really hard because you have to find a way to put together models in a similar way of a traditional asset allocation model, but you have to do it within a very different construct. And you have to try to think through what's affecting here, what's affecting there. So, how should people think about implementing this sort of a thing into portfolios, knowing that it's different. It's different
Yeah,
than the way their brain is wired.
yeah, it really is, Kirk. And one of the things that we have found is when you talk to most advisors, their typical portfolio is going to be comprised mainly of two parts, stocks and bonds. And as you pointed out, that historical relationship, from 2008 to 2020, stocks and bonds, for the large part, were negatively correlated. That means stocks go up, bonds go down. Stocks go down, oh, your bonds are going to go up. And that works until it doesn't. Since 2020, and we saw it in 2022, stocks and bonds have been positively correlated. That means when stocks are going down, your bonds are going down as well. And so, just taking a step back, the buffer ETFs, we view as really a new type of asset class. It's not an equity. You're tied to the equity markets, but you've got known levels of protection. It's not really a bond, though, either. It's got the defensive characteristics of bonds in that that if the market goes down, you will have protection. You don't have to hope like you are hoping with bonds right now, but there's no income. Um, and so it falls somewhere in between stocks and bonds. And what we found is that advisors have begun to utilize the buffer ETFs as another asset class. Typically, they are peeling a portion of their equities and more from their bonds and putting them in the buffer ETFs. I think a good example is beginning in 2020, interest rates were cut to zero. Interest rate, so bonds are yielding nothing. We had a lot of advisors coming to us and saying, "Hey, we've started to use your products in our portfolios, and we're actually using them as a bond alternative." And it's because bonds are yielding nothing. Why would we own bonds at this point? There's no more upside potential. There's only downside risk. But we can't just tell our clients, "Hey, we're going to just put you in the S&P 500. You're not going to have any hedge on the downside." So the buffers were a perfect, middle ground between stocks and bonds. And since that time frame, buffer ETFs have done incredibly well from a performance perspective relative to bonds, especially, but they've actually done fairly well against stocks as well. And one thing I want to touch on, Kirk, you mentioned, the people looking at historical performance of strategies, and one thing that we always like to say in the ETF industry is you've never seen a bad back test. And no one's going to come out and say, "Hey, I've got this new strategy," and you say, "Well, let me look at the back test," and it's a terrible performing back test. You don't see that. You always see people that have optimized, tweaked the performance just to make sure the back test looks really strong. I would argue buffer ETFs, when we brought these in 2017, the last 10 years prior, so 2009 to 2017, that was a really ugly time frame for buffers relative to equities because equities just kind of went up, bonds were just going up. And so a lot of people are saying, "Well, why do we need buffers?" Well, it's because you don't need to know what happened in the past with buffers because you know exactly what you're going to get over the next year. You don't know what you're going to get with stocks. You don't know what you're going to get with bonds, but you can look at these ETFs and know, oh, I've got 14% of upside over the next 1 year with this 15% buffer. You know exactly what you're going to get. And so, again, this was the first strategy, I would say, that we've really seen it adopted by the ETF industry, where the back test leading up to the launch wasn't really that great, but the live track record has actually been really, really strong.
Yeah, I love that. There's never a bad back test. It's one of my pet peeves of the industry. Some advisor comes in, you got a client and they're like, "Oh, I was talking to so and so and they said I should be doing this." And I look at him like, this guy literally just picked the best strategy. He's just like, "Oh, how can I beat what he's doing?" Well, let me put together some things that look great. And then they're like, "Look, I could have done this." And I'm like, "Yeah, but you didn't."
Yeah, yeah.
Like, yeah, I could have
You
done
see
that
these
too.
things. Yeah, you see it like, well, so how are you beating? Well, we had a 75% allocation to Nvidia. Well, of course you outperform, but no one. And I think, Kirk, that brings us up a great point, because people every year you hear these pundits saying this is going to be the year for active management. We do
Yeah.
not believe in active management. We think it's over time a fool's errand. And really, that if you look historically, and S&P has some great research on this, it shows that 95% of active managers over a 10-year time frame underperform the S&P 500. And that's often before fees. That's before taxes. And if you think about the last few years, they've been driven primarily by a few stocks like Nvidia. And so unless the active manager had a huge overweight to those names, it was nearly impossible for them to outperform. Why would that change going forward? We think the S&P 500, the benchmarks, are just a great way for most investors, high net worth, everyday investors, to access the equity markets. We are not believers in active management.
Well, it's interesting you say that. I've actually done a lot of research on this, and the conclusion I came to is actually fairly simple. If you look back prior to 2008, active managers were a lot more active. Now they're actually just index huggers, but it's not. It's really just professional career risk. Because if you think about the incentives, right? The incentive is, hey, I'm getting paid a lot of money to be a portfolio manager, so I could try to really blow out the performance of the index and maybe I get a small bonus, pat in the back. Or I could underperform significantly and I can get fired. So
Yep,
the perverse incentive is, well, just index hug. Well, if you index hug, it's index hugging minus the fees, which means you're going to underperform.
that's right.
It didn't used to be the case, but it's definitely become now because there's just no incentive for portfolio managers to do that. So I think the perverse incentive is, yes, I totally agree. Active managers will pretty much underperform forever because of that incentive, which kind of is unfortunate. But maybe someday in the future it'll change. I don't know. But yeah, when you
Yeah,
have 40% of the index in seven stocks, like,
I
yeah,
don't
that's
know. I
not
mean,
really
how
an
many
index
active
anymore.
managers are going to make that bet, and then take that a step further to the instruments that advisors have often used to protect their portfolio? We see hedge funds, we see some of these low volatility stocks, and I think hedge funds are increasingly coming under pressure because they haven't hedged. They haven't done what they said they were going to. You look at the performance in 2022, they didn't have positive performance. And so they too, their returns have been extremely underwhelming, and their fees, we want to talk about fees. The 2 and 20 is alive and well in these markets. And again, for people that just want straightforward investing with no levels of protection, that's really what yeah, I think the simplicity of our products is really what's attracting a lot of advisors and their clients to them.
Yeah, honestly, I wish I was a hedge fund manager a few years ago. I just would have put it all in Bitcoin after a big sell-off. You just wait till it runs up, and then you just sit on those returns. You take your 2 and 20. I mean, it's the other perverse incentive about hedge funds is basically they're incentivized to take massive risks, and if it blows up, they just basically close the fund and start a new one.
That's right.
And you can only do that so many times, but you can do it a few times for sure. And so their incentive is just like, let's just generate massive. massive leverage, and let's take home lots of profits. And I think what's interesting is you're right. I mean, there's definitely hedge funds that are a little bit more middle of the road. They're trying to shoot for absolute returns. But I have yet to, I mean, I think there's like the top 1% of hedge funds is what everyone wants. And unless you have $100 million, you're not going to get in. And so you've got this 99% that you're like, well, I guess I want a hedge fund. Let me just find one of these. And there's some good ones in there, but they're really hard to find. So I totally concur with that sentiment. But kind of getting back to your guys' stuff. What, I mean, adding a piece to a portfolio, okay, I get it. You're trying to, you're trying to tweak the performance. But, if you've got 95% of your stuff in efficient frontier MPT kind of stuff, like a traditional asset allocation, which the correlation is pretty much zero point 0.9 for everything in your portfolio, except for maybe bonds are zero point 0.7 right now. And you're putting in 5% into something that's different. So the two questions I have is, what's that actually going to do anyway? And the second one is, how do you actually look at one of your products and figure out how it's altering that performance? Because most of these the software we use goes back like 20 years, and your stuff doesn't. So how do you assess how it's impacting the portfolio, for one? And the second one is, like, if it's that small of a piece, like, what's it actually doing for people anyway?
Yeah, that's a great question. First off, I would say we have a research team here who analyzes hundreds, if not thousands, of advisor portfolios and figures out how to optimize the buffers in their portfolios to, again, even for more aggressive investors that maybe they're like a 90-10 split, 90 equities, 10 bonds, and they just held 10% of bonds, not for efficient frontier reasons. For some people, it's just, I just want 10% in defensive assets. Well, buffers are more tax efficient. They are likely to perform better than bonds over extended periods of time. But what we've typically found is, if you're trying to alter the portfolio, and let's say you're concerned about a market sell off, and so you're going to put a sliver into buffer ETFs. If you're going to put 2, 3, 4, 5%, that's really not going to have a material benefit, right? If you think about if the markets are down 15% and you had a 15% buffer in place, if you only have 5% of your portfolio allocated to that, it's really not going to have much of an impact. So what we typically see advisors doing to have a material impact is anywhere from 20 to 25% in the buffer ETFs. And that's where, again, where are they pulling that from? Because you can't just tack on an extra 20% or 25% to your portfolio. You got to pull from somewhere. Again, I would go back to most of that is getting pulled. I would say 15% or more. It's getting pulled from the bond bucket. Bonds have underperformed the last few years. A lot of people have just said, I don't need the income from bonds. It's just a tax drag on my portfolio. I've just used it to hedge the downside. And again, yes, buffers are use equities as the underlying, but they've got the known levels of downside protection. Um, that's why we're seeing the bond bucket being pulled from the most. But then again, they are tied to the equity markets, and so that's where we'll see maybe the other 10% or so coming from the equity bucket as well.
Okay. Yeah, that makes a lot of sense. Um, so it my guess is you guys probably don't do a lot of prediction, right? You guys are more defined outcome and just tweaking portfolios. I mean, what are your thoughts on markets? I mean, you're trying to design products around what people want. But if you would design a product around what you think is going to happen and how to do it, which I know is not the way to design products, right? You design products for what people want, not what you think they should have. Um, what would you create? What would you create if you had your way and said, "Oh, it'd be really cool if we did this. No one will buy it, but it'd be really cool if it existed."
Yeah, Craig, I've never been asked that question of, like, what type of product would you build if, like, one of the things that you realize is staying invested is just so important over time. And in some ways, it's been one of those areas where going back to the buffers, people use them to stay invested. A lot of times, we look at the research. I'm sure you've seen it. The average investor, you look at the S&P 500, it's does 9 or 10% a year. What's the average investor's experience? Pre-tax, I think it's like 3.5 to 4%. Why is that? It's because they're timing the market. They're trying to get in. They're pulling out at the wrong time, and so we're just trying to get people to stay invested. It's a good question. I would say, if it were if I were building a product right now, I would try to play the tails more. I would try to get some sort of leveraged upside in high returning equity markets and then protect the tail. So you're essentially paying for options premium that hopefully will be a little inexpensive. It will rarely pay off. And so hopefully you're capturing most of the returns in the middle. But if the market has a big up year, you're going to try to amplify that. And then if the market has a big down year, you're going to try to mute that. We have some of those types of strategies in our life, not exactly like that. But as you know, the tails play out more often than one would expect. 2008, that should have never happened. That was a once in 100+ year event. And then 2022 happens, and then 2020 happens, and who knows when the next crisis is going to be. And so, you know, like you said, we're not big on predictions, and predictions rarely hold out in our world. And I think we love standing by that. We love standing by saying we don't know. We don't know if equities are going to go up. We don't know if bonds are going to. Bonds are a great example. Everyone was saying buy bonds in 2023, buy bonds in 2024. The Fed's going to cut. They're going to cut. Yeah, they cut. And what happened in the 10-year? It went up over 100 basis points. Everybody in that space is underwater. Last 3 years on a pre-tax basis, they're down 2 to 3% a year when the equity markets have done 15 to 20% a year over that time frame. People are as bad at predicting the economy, the stock market, and interest rates. I mean, sometimes people think, well, interest rate, it's just math. Yes, it's math over 10 years if you're buying a 10-year bond. But what could happen over the next year? Nobody knows. And so that's, again, the beauty and simplicity of what we are trying to build here at Innovator is to just give people a little more certainty in a very uncertain investing world. And we're not going to provide home runs. That's not, like if you want to set up your own hedge fund and get Bitcoin and charge 2 and 20, have at it. But most investors are satisfied if they can get 60, 70% of the equity upside and then have known levels of protection. So we're just trying to keep things simple for advisors and their clients.
Yeah, no, that makes sense. I get that. So one question I have, and we'll kind of wrap it up soon. So if you look at your products, right? If you look at like a stock, like Acme products, ABC, whatever, come up with some random stock. It just goes up and down, right? It's just depending on where things are going. But your products are defined. So let's say, for example, and I'm just trying to understand how this operates. Let's say I buy in like 100% buffer, right? So there's 0% downside risk except for the expenses, but on price performance, it's 0% downside. So let's say I buy that. It goes from January to January. In December, the market goes down like 40%, right, for the year. And how would that operate? Because it's traded on the market, right? So people can buy and sell it. How does that work? Like, is somebody forcing it to be, at 0% loss at the end of the year? Or like, how does that work? Because
Yeah.
and then how does it roll over? Like, talk to me through the
Yeah.
mechanics of how these defined things work.
Yeah, I mean, it's often when we start this conversation, we always preface with it's a simple basket of options. And people, when they hear options, are like, oh, that sounds complex. We have been part of building hundreds and hundreds of ETFs over the years. These are the most simple ETFs we've ever built. And so if we think about the 100% buffers, what is providing that downside protection? It is a single at the money put that we buy that has a 1 year maturity to it. That means we are fully protecting all of the portfolio on the downside. Now, how do you pay for that? That's not free. Well, you have to give up some upside. And let's say over a year, that's 8%. So that means you're going to get 8% on the upside over a year, and you're going to be fully protected on the downside. And so let's just assume for simplicity the market's flat for the first 11 months. And then, like you said, Kirk, December hits and the market is down 40%. What is going to be the anchor for that ETF? Why will it not be down 40%? It's going to be because of that at the money put that we bought that over the full 1 year time frame will fully protect investors on the downside. There's no hoping, you know, there's no bank on the other side that you just have to cross your fingers that they stay in business, that an insurance company stays in business. You own that underlying option with these ETFs. And so at the end of the outcome period, so at the end of the 1 year, so let's say the market finishes down 40%. It was flat the first 11 months of the year and then drops 40% in December. So the market's down 40%. What will your performance be? You will be gross of the fees down 0%. You will be flat. And then what will we do? Let's say you put $100, or there were $100 in the ETF. We will simply rebalance the portfolio. We will buy a new 1 year at the money put that will fully protect your downside over the next 1 year. And then we're simply going to sell a call to fund that downside protection. And so in this example, the first year upside cap was 8%. We're going to go out and we're going to put the marketing competition to provide the highest upside potential possible. Let's say that it's 7.5% the next year. Well, then you know that for the next year, doesn't matter what the market does, you will get 1-for-1 on the upside to that 7.5% cap, and you will be fully protected on the downside. It's as simple as that. There's no active management. There's no people pulling levers behind the curtain. It's a set it and forget it portfolio. We don't touch those options positions until they mature. So our sub advisor, Milliman Financial Risk Management, they don't do any active management. And that's, again, the simplicity of helping advisors communicate to their clients. We know exactly what we're going to get. And Innovator has done this since 2018. And every single one of their defined outcome ETFs, whether it was a 15 buffer, 100 buffer, have done exactly what they said they were going to do. That's the type of certainty that investors are looking for today.
Yeah, and I understand that. What I meant is in terms of the price action, like what's the guarantee it's going to come in at zero, 0% loss if we have a down market? Because, I've seen with some of the buffers, like if the market goes down, they will dip. Like, from today until next January, if you buy one of those, the market goes down 40%, like the ETF price will go down. It won't go down with the market, but it will go down a little bit. So, and of course people look at their statements every day and all
Yep.
that. So
Yep.
I guess my point is A, why would it go down at all? B, why, what is going to cause it to come in at that 0%? Because it's going to roll over at a certain price, and presumably you want that price to be at 0% loss when you start anew. So what are the mechanisms that are causing that to actually make sure that happens?
Yep. Yeah. So that's a great point. Like you said, Kirk, all these ETFs are point to point. And what we mean by that is to realize the full cap or the full buffer, you need to have it for the entirety of the outcome period. And so let's just go back to your example of December, the market tanks 40%. What will happen in that 1 month time frame? Could you see our 100% buffer ETF trading negative? The answer is yes. I think the best analogy now, is it going to trade down 40%? Absolutely not. Why? Because that at the money put is in the anchor that that at the end of December, that at the money put will fully realize its value and the ETF will finish the 1 year flat. But in that 1 month time frame, could it trade down 1 or 2%? Yes, it could. And it's no different than buying, say, a 1 year bond. You know that at the end of 1 year, you're going to get your coupon and you're going to get your par back. Now, let's use that same example where you're in December, rates have not moved at all. And then December comes and all of a sudden rates spike. They jump 3%. You will see your bond that will mature in a month. It will trade down. But you also know at the end of December, it's going to trade back up to its par value. And so I think that's the easiest analogy for investors to help understand this concept of the ETF trading down potentially into its buffer during the outcome period. But again, I would encourage everybody, if they haven't seen our website, go to it. All of our ETFs have done exactly what they said they were going to do. We had these out in 2020 when the VIX went to 75, when the equity markets cratered 30% in the matter of a couple of months. We had ETFs out there. They did exactly what they said they were going to. Did some of them trade down to their buffers? Yes. Did they come back and give the stated downside protection over the full outcome period? Yes, they all did.
Cool. All right. Well, that's helpful. So as we wrap it up here, where can people find more about you and any final thoughts you want to leave the listeners with before we wrap it up?
You can find us innovatoretfs.com. And again, I think one of the things that we like to talk to advisors about is adding certainty in an uncertain world, whether that's on the equity side, whether that's on the bond side. We're a resource for advisors. That's who we work with. This is all we do. So hopefully you're going to continue to see new innovation coming from our firm to deliver payoffs that have never been available in the ETF wrapper before to our clients.
Awesome. Well, Graham, I really appreciate you coming to the show, sharing your wisdom with us. I got a product idea I'll share with you after.
All right. I look forward to that.
But thanks for coming on. We'll have you back on in the future because I know this stuff. I'm always a geek out on this stuff. So thanks for coming on.
Well, thanks so much, Kurt, for having me. Appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Graham. Really appreciate him coming to the show. Now we're into the panel portion of the show. We have our very own Barb Freeberg. Hey, Barb.
Hi, Kirk. Hi, Phil. Happy to be here.
Great to have you on. And we also have our very own Phil Weiss. Hey, Phil.
Hey Kirk, hey Barb, happy to be here as well.
Great. Well, let's dive right in. So, Barb, what were some of your takeaways from the interview?
Well, first of all, for those of you who don't know, there are probably at least 6,000 ETFs in the market. And in addition to that, there are tens of thousands of mutual funds. So today we're going to just cover them all. No, just kidding. Today we're going to delve into what about these specialty ETFs that can cap your downside? Yay, we love that. But then, on the trade-off, when you see the S&P going up 20% in a year and your capped ETF just goes up 10, how are you going to like that? So I love talking about this. So let's just get at it.
All right. Well, we'll go after the 999 mutual funds. And Phil, what are some of your thoughts? What are some of your takeaways from the interview?
So Barb's right. We like to cap the downside. That's always something that appeals to people, but limiting the upside, people aren't nearly as happy about that. ETFs in general, I really like them. I mean, that's what I use in client portfolios, and I don't use mutual funds because ETFs have, to me, a lot of advantages. But when it comes to these type of products, I get a little bit more leery of them. But it was really interesting because like I learned more by listening because I know of these. I don't use them, but now I have a much better understanding of exactly how they work.
Yeah, it's interesting. I have to say, I mean, I appreciate Graham coming to the show because I've looked into these a lot, and I'm always fascinated with new ETFs about we have the traditional mutual funds, the actively managed, and we've got the indexes, and a lot of ETFs are indexes or quant based or they've got all different flavors, which I find to be really interesting. It doesn't mean you have to invest in them all. Like there's two or three ETFs that I love to track, but I would never touch. One tracks momentum, one tracks equal weighting. I wouldn't touch them because it's not going to accomplish what I'm trying to accomplish. But they're really fascinating to watch because you can see. I'll give you an example, like the S&P 500 versus the S&P 500 equal weight. I can track like how one is doing versus the other, and that actually has measure in terms of me interpreting how the markets are doing. Because if I think that the markets are one-sided and seven stocks are taken off, and I see the equal weight not doing anything, that validates my point because the other ones equate like 40% of the S&P is in seven stocks. Well, I can see that just by watching whether they're tracking each other. So you can get some fascinating information just from some of these things. But, Barb, I know you love indexing, but tell me, like, what would you consider as kind of like an off book kind of ETF that you've looked at in the past, or something that you like, or like where's your head at with ETFs? Are you plain vanilla, or you ever go outside the box?
I love this question because I go outside the box because not a lot. For example, the like 2 or 3x leveraged ETFs that will promise to deliver like 2 or 3 times the return of the S&P 500. Now, if I was a gambling gal and I thought the markets were going to go up, yeah, sure, that's a great deal. But I don't want to see those losses. Those type of extreme ETFs, I don't touch them. Now, the market cap, predominantly most of our ETF monies are in those. But to your point, the RSP equal weight, I do have a position in that. I'm not telling you to take a position in that, but we do because it's more value based. And so when the big seven are dominating the markets, well, that ETF is going to do worse. But when you see a broader market movement, the RSP will do better. Being a value investor, I like having a little bit of that in my portfolio. Additionally, and obviously it's no secret that I do like a bargain, I also like factors. So bond funds are a whole different thing. And we could spend a whole show talking about bonds, bond funds, active, passive management, and there's so much to talk about. But in my bond fund investing, I go with a couple of factor weights. So these are actively managed, and the managers are trading the bonds to try and give you the highest quality and the highest returns. And personally, I like a little bit of oversight in bond investing. So that's where I deviate from the typical. It's really plain vanilla. Actually, I do have one more. I have an investment in a growth at a reasonable price ETF. Again, another value pick. And I promise you, one day I'm going to be vindicated. Not today, obviously, when growth is just taking over the world, but I still believe value will show its stripes again.
So, Barb, can you define factors for us a little bit? Because that's what I was thinking of earlier. I just couldn't come up with a word, but the factor investing encompasses a lot. So, can you kind of define that?
Okay, well, with factors are specific components of a type of investment. So when you think of like a small cap ETF, small cap is the factor. It's not an overall generalized S&P 500, but it'll ferret out the small cap companies. A mid cap company might be a factor. In bonds, they'll look at other things. A factor might be the credit rating. So they want all bonds related to a specific credit rating. Or another factor in bonds might be the volatility, the duration, which is the term. So factors are just think of them as kind of like niches within either stocks or bonds or whatever type of investments.
Yeah, that makes sense. Yeah, I've always been fascinated with the factor part. You just got some like, high beta, low beta funds. Like they got all these weird things, and it's like there's a flavor for everyone. Like anything you want to do, they got an ETF out there, and that's why.
There really is. And a lot of it comes down to predicting, which is what do you think is going to happen next? And I just want to speak on this because I rebalanced our family's portfolios yesterday and got myself in a little bit of a tizzy because the stock market is as highly valued, excluding the early 2000s, than it's been in 50 years. And mark my words, at some point there's going to be a drop. And that kind of made me nervous. And what do I do? And how can I handle it? And whatever. Um, but in reality, you just have to be aware as an investor of what do you want to accomplish? And do you want to speculate a little? And if you want to speculate, then take some of these unusual, or I won't say unusual, I'll say non index fund ETFs and put some of your money in those.
Yeah, that's great.
And maybe you'll beat the market.
Phil, what are your thoughts?
So the number of ETFs it's even crazier. Like Barb didn't even go to the extremes where like you can get single stock ETFs that are leveraged to that stock. So yesterday or 2 days ago, I guess it was, Nvidia went down 17%. There are ETFs that were leveraged two times to NVIDIA. So that means that you went down 33%. So when we talk about speculating or gambling, like they're really vehicles that'll let you do almost anything. And like Barb, I'm more on the asset allocation side, and I will look at certain factors when I look at ETFs, look at market cap. If I have something that needs income, I might look at something that provides more income. On the bond side, I used to use ETFs, and I saw what happened in 2022 when rates moved and the ETF prices didn't move at the same pace as the bond prices or in the same direction all the time. And that's because they own a bucket of bonds and they can't just say, okay, interest rates change. I have to sell everything. I'm going to buy new and equal what how the market looks. So their performance was different. So I've actually moved to, instead of using ETFs, I primarily am using treasuries on the fixed income side because I like where the yields are. You can get between 4 and 5% on treasuries of different durations or maturity periods. And that's yield to maturity. So like I had to explain this to a client the other day. Like it might say that it's a treasury paying 0.5%, but think about it. If it's paying 0.5%, nobody would want to buy that bond when current rates are over 4. So what happens is bond prices and bond values move in the opposite direction of interest rates. So if that treasury is paying 0.5%, you're going to buy it for less than par value or the value at maturity. So you might buy for, let's say, 950, and then during the time that you own it, the accretion in value from 950 to 1,000 plus the interest is what you're going to earn. And that's going to turn out to be the current market rate. And yes, there's always risk because we don't know what's going to happen when they mature and rates can still move. But at least if you take that, you've kind of taken some of the uncertainty out because if I hold that bond to maturity, I kind of know what I'm going to get. But I will, again, on the HTS, I will use the different factors based upon market cap or certain things that a client needs. The one thing that always concerns me about these products like the buffers is I know that people don't like when the market goes down. But here's the thing. Over the long term, the S&P returns around 10%. That includes years like 2008 when the market went down 50%. But it also includes years like the last 2 years, the market went up over 20%. So when you add it all up, if you have the stomach to last through, you're going to get better returns by having that market exposure than you are when you limit the downside because of the fact that in exchange for limiting the downside, you're also limiting the upside. So you don't get that same benefit when the market goes up. So that's always the thing that concerns me. I mean, there are times that these can work for people based upon their situation. Like, look, when you retire, especially right around retirement, if the market falls a lot, that's really damaging because you don't have the ability to invest to take advantage of it. But for most people, if you're taking a long-term approach, you can get through those market downturns and you end up with better returns than you do when you get capped.
Yeah, no, I think it's interesting comment you make, Phil, because I think one of the fascinations, and this is why I enjoyed the conversation with Graham. Um, I mean, basically what they're doing is options strategies, and a lot of people who've done structured products, if you're with a broker or if you're dealing with a broker, they do these a lot, and they call them structured products. They may call them something else. They might have a different name, but they're basically under the structured products category. And structured products are basically just option strategies that are bulked together under an ETF, under a symbol, a ticker that you can buy. And they're typically brokerage products with commissions attached that you don't see. They're baked in. Anyway, the point is they'll say, all right, here's the way it works. And they'll give you some complicated thing. It's basically just underlying, typically with options that they've constructed based on markets, based on other things that we won't get into. I don't typically like structured products because they originated because the brokerage firms are trying to dump huge positions. So they put an option on it and then they created a product around it. A buddy of mine told me this a while ago. Like the original ones were like, you had some huge client of theirs, like $200 million position they couldn't dump in the market. So like, all right, we'll package it up and put some options around it and make it all pretty and people will buy it. And they did. They never worked out, the original ones, by the way, none of the ones I ever saw. But as a concept, they're interesting. And so I look at like what Graham's doing, and you're right, Phil. And you know, I think what a lot of people don't realize, so I've done the math a while ago because I was trying to come up with like, how do you come up with the best strategy that accomplishes all the things you're trying to do? And I found some interesting stuff. Like one of them was like 70% of the time the market is either either up 10% plus or down lower than negative 10%. So it's only plus or minus 10%, 30% of the time. And if you look at it, like there's some big years, 30%, 25%. I mean, last year was 23%, some years was 30%. And then that's offset with some years are maybe like down 5 and people don't like losing money. But it depends on the investor, right? Like some investors, like if you're 65 years old and you're retiring and you want to have equity-like returns without equity-like risk, this could be interesting, right? Because you don't want to lose all your marbles at the end of the game, right? You've done a good job saving. But if you're 35 years old, put it all in red, right? Just put it all in and take the chance because Phil's right. Like if you look at the odds over time, yes, you got some ups and downs, but as long as you keep adding, you're going to be in better shape by just going all in. You got to take a ride, you know. It could be a bouncy one, could be a lot of roller coaster rides from here to there, um, but overall, you should, and in air quotes, should do better, right? Because if you look at history, it has done better. But you look at Japan, it didn't for like 30 years. So you can't guarantee it's going to be fine. So there's all this back and forth, and it's always a game of and I'll ask you the question, Barb, because the U.S. So growth for the last 20 years has been the place to be. The U.S. has been the place to be for the last 20 plus years. I guess it's 25 years now. When's that going to change? That's not historically normal, right? And if you're looking at all these different factors, you're looking at these different types of ETFs, how do you make a choice when 25 years, you know, for Japan or 35 years, that's a long time for the market to be down. But basically all the money came here for 25 years and pretty much went into growth. So, outside of just picking 7 stocks to invest in, like how do you determine what the right factor is? How would you look at a portfolio and consider like, different ETFs kind of like this or other factor ETFs? How would you think about that?
I was recently listening to a podcast by Eugene Fama, Nobel Prize winning economist, and one of the Fama and French team who actually developed the research on factor investing. And he was talking about active versus passive investing. And he's big into the efficient market hypothesis, which says most stocks fall to their true value because of supply and demand and because of their value. So, what he said, the length of time that it takes to really determine whether a strategy like an active strategy works is, wait for it, a lifetime. So 20 years may seem like a long time to us, although those of us who are older, 20 years is like, not so long. But if you're 35, yeah, 20 years is a long time. So my point being that different trends can go on for a very, very long time. And so back to your question, Kirk, how do you structure a portfolio? Well, you can do a couple of different things. One, you can play the long game, which I give you even at age 70, with lifespans growing as they are, you might have another 15, 20, 30 years left. And so it leads back to the old tenet that in order to profit from changes, it's not a bad idea to just have a broadly diversified portfolio. When growth goes out of fashion, when the US falters, then you're going to have some international and you're going to have some value stocks. Now, if that is not suitable for you, then you can play the momentum game and go with what's most popular now and hope that you get out before the trend switches.
Yeah, no, I appreciate that, Barb. Phil, what are your thoughts? Like, um, how should people be thinking about this? Because no, it's not for everybody, right? Like some people are just plain vanilla. But how should people be thinking about this? Is this for everybody, or are there things that people should strongly consider?
I don't think it's for everybody. I think if you want to do this, you want to designate or set off a certain part of your portfolio. Say like this is my play money, or this is my gambling money, or this is my I'm gonna take a shot money. And that's what you put this into, and don't mess with it. Like don't make that too much because it's hard, and like investing itself is hard and it involves a lot of decisions. And once you start to get into momentum, or you start to get into the latest trends, you start to get into trading, it means you have to make more and more decisions. And to me, the more decisions you have to make, the greater the chance is that you're going to make a wrong one. So I like the idea of having a process that says, here's what my asset allocation is. I'm going to be broadly exposed to different parts of the market because I don't know what part of the market's going to do the best in any one year. Like if you look up asset allocation quilt and you look at over 10 years, 20 years, 30 years, whatever it is, you'll see that it's not the same asset class that does the best every year. Like Barb said, over the last 20 years, growth and US have been really good. But if you go back before that, international was good. Value's been good. If I look at the history of the market, small cap value has probably been the best performing asset class. Now, I can give you some reasons that that might change because the market itself has changed. But we look at different periods, different things happen. And since we don't know, I mean, even on the Graham even talked about that, like we don't forecast. We can't prognosticate. Like if somebody asks me what my prediction about the market is, I'll start with my crystal ball is both cloudy and cracked. I don't know. I don't have a crystal ball that tells me what's going to happen. So that's why I prefer to take an approach that says at least the bulk of my funds are going to be invested using an asset allocation strategy so that when the market doesn't do well, they don't go down as much. I know I'm not going to outperform. Like if you didn't invest in the S&P 500 as your basically your sole holding, or forget the individual stocks, just at that level, you didn't perform as well because it's been the leader. But that's not always going to be the case. And I think if we were thinking about investing as helping us achieve our long-term goals and objectives and allowing us to live our most desired life, we don't need to necessarily beat the market. We just need to earn enough to allow us to live that life. And the last thing I ever want to do is have a call with a client, say, hey, those great plans that you had, we had a bad market. Now we can't do them. That's not a call I want to make. So I'd much rather take that more conservative, diversified approach.
Yeah, no, I agree. And this and the factors and any of these ETFs are not for everybody. Totally agree. But I do agree that they do accomplish a goal. The question is whether the goal is one that you want to accomplish. And I think that's really the point here. That's why I brought Graham on the show because it does align with some option strategies. It's things that I've used, other people have used. They do accomplish a goal. Whether it accomplishes the same goal you want, totally different question. And I think that's up to each individual investor. But I do like the idea of these because they do accomplish some goals that I've seen that people want. So and we're going to wrap it up here. Barb, final thoughts, and where can people find more about you?
I love the idea of investing with the market with 95% of your portfolio in a diversified way, international, US, maybe some different cap sizes, and then some bonds or some cash treasuries fixed. And then with that extra 5 to 10%, do whatever you want. Try out whatever strategies you want. Use a 2x fund or invest in Bitcoin or whatever. You won't kill yourself if that strategy does not pay out, but you might surprise yourself with a nice added boost in return. I'm Barbara Friedberg. You can find me on YouTube and also at Barbara Friedberg Personal Finance. See you next time.
Thanks for coming on, Barb. Phil, final thoughts from you.
In general, I agree with what Barb said. You want to take that diversified approach with the bulk of your portfolio. There's always going to be times, or not always, but there can certainly be times that you can take that 5 to 10% and put in something different. Or some people with their comfort level, like having a product like this that says, I know that this part of my portfolio is protected, it helps them mentally. It allows them to do some of the things that they want because they know that part of their portfolio is protected. So you really have to do what's best for you. So I'm Phil Weiss of Apprise Wealth Management. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you're facing a new beginning, you can take our Flourish Through Life's Big Changes assessment at apprisewealth.com/assessment to discover how ready you are to embrace and thrive through your significant life transition. You can also sign up for our blog. Thanks for having me today, Kirk.
And thanks for coming on, Phil. And thank you both. And thanks, Graham. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.